Welcome to the Alts Pulse. We're live here from iCapital Connect in Phoenix. I'm here with Kunal Shah from iCapital.
Michael, thanks for having me. We have been talking about this for months. I'm excited to be on this.
Oh, pleasure to have you, Kunal. We've talked so much about private markets, about diligence. Yep. Love talking with you, so I'm excited to get into it. First, I want to start with your background.
Yep.
I think it's actually very informative as it relates to how the wealth channel can be thinking about private markets. You've kind of, your background is really emblematic of that evolution. Yep. In a sense. What have you taken from your time at Makita and also Vanguard too? So there's this kind of combination of both public and private, yep. Which is another theme here, the convergence of public and private. So we'd love for you to share your background and then how it has helped you kind of inform how you think about private markets today.
As you know very well, I have been doing this for about 20 years. About half of that time is institutional with Makita, and the last 11 years at iCapital, doing mostly for wealth channels. And the idea remains the same, right? Which is everybody wants to get access to high quality products and alternatives. And the manager selection piece that we will discuss, I'm sure, is a critical part of how do you procure that product for our client base. At sort of the difference between the institutional channel and the wealth channel is mostly around focused allocation. Institutions have a long-term allocation that they stick to. Wealth is it's in a journey. In many cases, they don't even have an allocation. And so we are trying to create a framework for them to have an allocation. So it's more of an educational-led effort in wealth, whereas institutional is more around your existing demand base. You just have to keep allocating to maintain your allocation ranges.
What do you think the wealth channel can learn from how institutional allocators approach private markets?
Stay with it. Discipline, stay with it, right? We discuss this so many times at iCapital is you cannot pick a vintage, you cannot pick a period. And so don't think about missing something, don't think about like sitting out for a period. Every year you got to keep allocating, whether it's venture capital, private credit, infrastructure. The dollar cost averaging concept applies to private markets as well. It just applies in different format because you have to keep making allocations to catch up to that number.
So I think you'll have an interesting perspective on this because now you are core to not only the diligence efforts at iCapital, but the construction of models.
Yeah.
And interesting and unique product around these model portfolios, multi-manager products, but you've also obviously allocated to single managers. How do you think about that, what you just shared, as it relates to sticking with private markets and some of these new products as it relates to the wealth channel or new structures?
Yep.
Model portfolios, multi-manager, evergreen structures, as it relates to kind of this idea of vintage fund concepts, or
yep.
Like, will that all change now that you have models and evergreens and things like that?
If you think about evergreen is a game changer for the wealth channel, right? You need evergreen structures because that's how wealth channel is used to investing in alternatives. Institutional investors got used to investing in capital call structures. Wealth channel is not going to get there, so evergreens were needed. The creation of evergreen structures actually led to the creation of model portfolios because the whole idea is based on an allocation to alternatives that you will frequently rebalance based on market environment as well as the underlying fund components and how they perform as well. And so model portfolio is totally dependent on the availability of evergreen products. Now, there is one thing that you touched on which is important, especially relevant in today's market, which is the deployment piece, right? If you are going to be investing in alternatives, you want to stay with that evergreen fund and you want that evergreen fund to continue deploying capital depending on every cycle. If for whatever reason the underlying managers, because they are facing redemption issues right now, or if they stop deploying or they don't have as much capital availability, then the vintage idea comes in play because you have under allocation to current exposure and over allocation to yesterday's exposure, and that's not what clients want, right? Client wants a consistent exposure, and that's where the skipping of a vintage can come in play.
So I want to get to an important nuance here. So as it relates to evergreens, yep. The larger managers are generally the ones doing evergreens because they have the size and scale, deal flow, pre-investment, they have the ability post-investment to handle all of that. Smaller managers, that can be where there's unique access, differentiation to markets, maybe outperformance in certain areas. Not that larger managers can't outperform either, but how do you think about the advent of evergreens as it relates to accessing interesting, different, and unique parts of the market where investors can really get alpha?
Yeah. So every one of them is thinking about it. I wouldn't say everyone like the small end of the market, but if you're a firm that has at least 4 or 5 traditional drawdown funds, is thinking about how do they tap the evergreen market for a bunch of reasons. The core market, which is institutional investors, they are not allocating as much capital as they used to before. Many of them are fully allocated. Many of them have regulatory caps. If you're an insurance company, you cannot do more than a certain percentage of the portfolio. So wealth channel becomes very interesting. So we are obviously in the middle of that. And we get a lot of GPs, fund managers come to us and say, how should I think about my fund structure vis-a-vis what the demand structure is from the wealth channel? So long way of saying, you should see more of the managers entering the space. Some may enter through a more of a multi-manager structure like what we have done with our iDirect program, where we put together 3 or 4 funds together and go to market and provide exposure that way. Some will do single manager. We are seeing also interesting stuff happening from segments such as venture capital, where some VC managers would never think about becoming an evergreen manager. We have seen a trend. Some of the largest managers like Sequoia are essentially at an evergreen fund structure now, but even the others are entering the wealth channel with an evergreen product, providing more direct access as opposed to secondary co-investment access.
What do you think evergreen structures and the growth of the wealth channel is going to do to the business model of the GPs as it relates to how and where they invest, they have an edge, and where they can outperform?
So the most important factor that GPs need to focus on is, can they scale the deal flow and maintain the quality of deal flow? Because evergreen has one negative thing, which is the money comes in and that money needs to get deployed right away. You cannot sit on cash. Cash is a dilutive factor, which essentially is the biggest reason some investors are still considering whether they should do evergreen or not. So the deployment is very, very important, and they have to maintain the quality of deal flow and scale the quality of deal flow. So that's number one, right? Now, from a GP perspective, why is it attractive? Because many large managers, even middle market managers, they give out co-investments for free, right? Insurance companies, pension funds love that because that essentially helps them lower their overall fee basis that they give to that fund manager. But that deal flow or that extra capacity is not monetized by the fund manager, historically speaking, through evergreen structure. Now they have more pockets of capital for the same exact deal, which they can monetize, improve their own sort of balance sheet and improve their own earnings, right? So that's important, but it's a balancing act. You cannot cut off the institutional investors completely because they are the ones that feed your main business, right? So I think they all have to work through a very delicate balance, but there is an opportunity for them to improve their own earnings by leveraging evergreen structure without compromising on quality. As long as that is intact, I think they will be fine.
How do you think the evolution of the wealth management market structure, so what I mean by that is this consolidation of OCIOs within larger wealth platforms, as these wealth platforms scale and consolidate other wealth managers, they're centralizing the CIO function. How is that playing into how wealth management firms may think about allocating to GPs broadly, but then we can get to some of the nuances like we just discussed, like where do they find smaller managers? How do they think about co-invest? How do they think about larger managers?
It's a fascinating space to study and constantly study. I think it's changing very rapidly, right? Many of these RIA platforms, OCIO platforms, they are institutions or even bigger than institutions, right? Look at we are sitting in Arizona. If I had to guess, the size of Arizona pension fund is probably $40-50 billion. You and I can count at least 20 RIA platforms that are bigger than that.
We're all here.
Right? So that changes the way GPs think of them, right, as well, because there's a deep pocket of capital that is actually under allocated, and then you can go to them and say, let's create products or let's create a solution for you to seed some of these products. The difference is that the approach by these wealth platforms is not consistent, right? You go to a pension plan, they operate exactly the same way. The decision making is somewhat the same way as well. But the wealth platforms, some are centralized, some are not centralized, right? And the decision making as a result of that is unclear for GP community to figure out how do they scale. In some cases, the head of research or CIOs approves it, and it sort of cascades down to everybody in the organization. In some cases, advisor driven, right? And so that's the biggest thing that we have to pay attention to is how do the CIOs or the heads of research at these firms, how are they going to start influencing the decision making of the advisor community?
You'll have an interesting perspective on this because you've always adopted that consultative mindset, and I think you bring that to the conversations that you have with many of the wealth firms that you work with. How do you think they will think about where they differentiate versus where they think about balancing that with scale? Because scale means you may have to deploy large amounts of capital that only works with certain size managers, but they also need to differentiate. How do you think they're balancing that tension?
Yeah, I think I think they will do more proprietary products, especially getting exclusivity by seeding a product. So we have seen more evergreen products being seeded by a small group of RIAs, and they want some exclusivity so that the competitor cannot show their product. In some cases, some RIAs are creating their own evergreen products, right? And they are keeping it to their clients, and they are using that as a marketing tactic to get more clients in. So everybody is going to approach it differently. But one thing is also very clear, that they are actually thinking about investing across the stack and not concentrating in the largest asset managers either, right? Largest managers will get their share because by market capitalization, they are the largest component, but they do want exposure to small and mid-market as well.
So if that's the case, so something like venture, low mid-market private equity, that may be harder for those funds to do evergreen structures themselves. What are the product structures and wrappers that are going to enable the wealth channel to think about accessing those firms, doing their co-invests, CVs, things like that? What are you seeing around product innovation that's enabling them to access that part of the market?
Yeah, I mean, I think that's a great question. Outside of evergreen, nothing new that is coming, right? So everybody's creating a rig, they're investing in a rig, they're getting exclusivity for a rig, and that's what we are seeing. I would be surprised if we don't see more discretionary practice emerging within those alternatives platforms or within those wealth management platforms for alternative investments. Because one of the things you and I both know, those smaller managers, those venture capital managers, they move much faster in terms of fundraising. And having an ability to move fast, match their speed, requires some level of control over the underlying assets. And so as these firms are getting bigger and bigger, and they operate more like OCIOs have one thing in common: they have control over the assets, and that will, I think, it will emerge. So that's not a structure evolution, that's a practice evolution in my mind.
What do you think GPs need to do to be able to make sure that they serve the wealth channel well?
Education, and make sure that they are providing good amount of transparency around how these products are structured, because the skeptical mind for everybody, whether it's wealth platform, whether it's IBD, is that GPs are here to raise money because they want to grow their AUM. You want to make sure that those products are presented the right way with the right investment objective, and then you keep educating the advisor channel because they may not understand every component of private markets. And so GPs just need to make sure that they are transparent and provide all the resources that they can.
So you bring up a really interesting point, which is, as firms grow and scale, they need to think about how they still generate alpha, or find where they still have an edge. That makes me think of the wealth channel. How do they discern what manager edge is? Because scale doesn't necessarily mean lower returns. It certainly can at times, but it doesn't always. And then certainly in the lower end of the market, there's inefficiencies that would suggest that at times they can actually outperform their larger cap peers, something like private equity. How can wealth managers and wealth channel allocators think about the nuances of discerning manager edge?
I think every wealth manager, from a due diligence perspective, needs to focus on where the alpha is available, right? Alpha is largely a factor of small, mid-market, so buyouts. Large market also has alpha, venture capital and growth equity. There's some alpha in secondary, some alpha in direct lending, but the alpha is somewhat limited. Private credit can only give you so much. Upside is limited. You're caring about downside. When it comes to those alpha generating categories, the most important factor, or there are two important factors in my mind, is your ability to get high quality deal flow and a consistent ability to get high quality deal flow, right? Are you going to be able to get into that large language model company, the next generation, before your competition gets in? And how did you find that company? What is your network effect that brings that deal flow to you? One, and then second is how do you help that company grow, right? You and I both know there are a lot of fund managers out there. Many of them don't add much value, right? You need to add value. You need to help them in recruiting. You need to help them in governance. You need to help them with strategy. And so, really taking the time when you meet the fund manager, going through case study by case study by case study, understanding the consistency of how they have scaled any of their success stories, but also spend time on their failures and understand what are the lessons learned, and is there a consistency there, is the most important factor.
What is the most effective question that you ask a manager in diligence that really gives you that insight into a manager as to whether or not you think they're going to have edge or have a unique or special differentiation?
Yeah, there's no one question that comes to my mind, but I think when we spend time with fund managers, the area that we spend most attention is, talk to me, there are two areas. Talk to me about how the decision making is happening at the firm level. What I mean by that is, how did you find this company? Who were the people involved? Who were the people presenting and negotiating structure, and who is sitting on the company's board, right? You want to make sure that there is a collective effort and not a star system at that fund manager. Oftentimes, the lead partner will become the face of the firm, but there is a lot of bench depth that is needed for that partner to be successful. So understanding the decision-making process, and then really going deep into the portfolio, quality of portfolio, how are they growing? Sometimes the simple answer is on a spreadsheet. How did your earnings grow? How did your EBITDA grow? How did your revenue grow? You can tell all kinds of story attached to that, but if the numbers don't add up, that's the fact, right? So we spend a lot of time, it's like, tell us, if you're a private equity manager and you are add-on acquisition focused manager, okay, show me your organic growth and show me your inorganic growth. Try to understand, if you think that most of the value was through add-ons, great, but I also want to understand what the organic part of us as well.
If you could give advice to those in the wealth channel who are newer allocating to private markets, what would be the key point that you'd provide to them, having the 20 years of plus of diligence experience that you have working with managers sitting across from them, yep, seeing them allocating to them?
Look, I think it goes back to one of the first things I said, which is stay consistent, stay allocated, right? One of the things we talk about all the time is ABC, always be committed, right? You gotta constantly allocate private market capital, especially when you're new. The beauty today is you have the ability to blend evergreens and drawdowns, and use evergreen as your core allocation, because that can get you exposed right away, and then use drawdowns as a satellite approach to fill in areas that you're not going to get in evergreen. So you're not going to get early stage venture capital in evergreen. Go and find a drawdown for that. You're not going to get every part of the small and mid-market buyout in evergreen. Go and find a manager for that. And so try to build out a portfolio that is giving you exposure and diversification across the entire spectrum.
The ABCs of diligence. I always learn something from you when I talk with you.
Awesome,
so
man.
Great. Thanks
for having me.